Welcome and thank you for joining us today for preparing for the next phase of ASC 842, ensuring long-term lease accounting success with LeaseCrunch. Welcome to everyone. I want to just have a few points for all of you. All participants will be placed on mute during the presentation, but during the Q&A section, feel free to unmute yourself to ask questions. You can also submit them through the question function in your webinar app. This webinar is being recorded. The recording and slide deck will be sent out within a few days. CPE credit is available to attendees who answer all 4 poll questions scattered throughout the presentation. If you are looking to get CPE, you must answer all 4 polls to be eligible. If you qualify, the CPE certificates will be sent out to you via email within the next few weeks. There will be a survey that appears on your screen at the end of this webinar. Your feedback is very important to us, and we want to provide you with as much value as possible through these webinars. If you would take just a few minutes to fill that out, we would greatly appreciate it. For those of you who may not be familiar with Richey May, we were founded almost 40 years ago to focus exclusively on the needs of the mortgage banking industry. This singular focus from our experts enables us to help lenders accomplish their goals. Our experts believe in the forward progress and success of the industry and dedicate much of their time to teaching through webinars like this and building others through the MBA School of Mortgage Banking and at other industry conferences and associations. And with that, I would like to turn it over to Josh and Jess.
Hello, everyone. It's a pleasure to see a lot of familiar names on the attendee list, a lot of internal as well as external. Just to give you a little bit of background of LeaseCrunch, and I'll let Jess take it over. We found LeaseCrunch about, I'd say, 16, 17 months ago as just a great resource, not only for internal training, but as well as for our clients, and has been a great partnership in working with them through ASC 842 and all the fun that it has in store, or had in store and continues to have in store for us. They're our preferred partner, both from a standpoint of leveraging their software to get our clients onboarded, as well as utilizing it as an audit function for those that might be utilizing another software and/or Microsoft Excel. So with that, I'll turn it over to Jess, so she'll take the lead on this presentation today.
Hi all, my name's Jess. I lead training and support here at LeaseCrunch. Just a little bit about me. I've been in the world of leasing since 2006 or 7, working in property management. So I spent a lot of time on the lessor side. In 2021, or very early 21, joined the LeaseCrunch team to lead training and support. So if you have been to a training or you've been to a webinar, it's probably me speaking. And before we move on and talk all things lease accounting, Abby, welcome.
Hi. I'm Abby. I am the account director over at LeaseCrunch that works with Josh and Richey May. And I'm excited to have put this on, and I was going to introduce Jess, and so my words that I had are a little backwards, but hi, I'm so happy you could join, and Jess is very informative. I'm sure people will have questions at the end, but I would expect her to cover most of the things.
Thanks, Abby. Sorry we got out of order on you.
No, that's fine. I was just like, I don't know.
That's definitely on me. Apologies there.
All right, so let's get started. Let's talk a little bit about LeaseCrunch. Like Josh mentioned, we are a lease accounting solution, fastest, easiest to use lease accounting software on the market today. I'm going to skip over what we do because Josh already kind of mentioned that, but we work with almost 600 CPA firms, 20,000 companies. So when you think about the breadth of our knowledge, both from an industry perspective, but also who we're working with, we're hearing stories from very large organizations and very small. So I keep saying we've probably heard it all, but I think that's probably not the truth. So a little bit about our agenda. We're going to talk through all things lease accounting, kind of day 2, what's next? Well, I'll talk through some best practices, questions, and comments that we're hearing from our staff, from our clients, coming into our support team, and then Abby's account management team. We'll talk through some new leases. I like to think about and explain my thought process when it comes to how I would handle a new lease under ASC 842. We'll talk through all the different ways that leases are changing, best practices for reconciliation, and then some new things and kind of other items such as the common control ASU that came out earlier this year. So day 2, post-implementation best practices. We've implemented 842. We now have these leases recorded on our balance sheet, but what do we do next? So I'm going to talk through a little bit about what we see in day 2. And pardon me while I skip and get my screens in order. Okay, so lessons learned. Hopefully, many of you are sitting on the second half, or next second day, second step of lease accounting and thinking, man, my implementation went great. I found all of my leases, I recorded them all accurately and had no issues. And if you are that person, I want you to tell me, and I want to talk to you about what you did well and why it worked. We know that that wasn't always the case for most organizations. Some organizations just struggled with lease accounting, either understanding concepts, identifying a full lease portfolio, all sorts of reasons. But what have we learned? We've learned that it's really important to identify our full portfolio of leases, be talking to other parts of your organization to make sure nothing was missed. We're going to understand those expenses. They're relatively the same as they were before, except for our operating leases are different. We're now recording asset and liability on our balance sheet and appropriate expenses to go along with that. It's a little bit different than what we had been recording in the past. One thing that we hear is, and I think is a great recommendation, is building a post-implementation leases team. So have a couple of people from a couple different parts of the organization coming together to talk about things like, how do we manage our leases better? Who's making changes to leases? Who's signing new leases? And that kind of flows into tracking new contracts and changes to leases. What have we done well? And are we continuing to do that well with lease accounting? Now, what I mean by that is we might have people in legal that are signing contracts or signing new leases. Do the people on the legal team understand that accounting needs to know about those new contracts so that they're recorded correctly on the balance sheet? We want to keep track of these items, and also I want to tell a little story about 840, and we always did it that way, and how that might not work well for us into the future. Not long ago, I spoke with a senior accounting team, a couple of people working together to move their lease accounting from Excel to software. They're coming over to LeaseCrunch. Their CFO, however, is adamant that they do not change how they've been recording expenses from an accounts payable perspective. I wasn't able to dig into the reasons why, but they are very adamant that how they record their expenses is not changing. So imagine we're recording, we receive an invoice, we record that invoice through our accounts payable voucher system, and we hit debit to expense. Now this team is having to unwind that expense, and into the future, next month and next year are going to also be unwinding those expenses every month so they can correctly post their 842 entries. So my question to you is following the 840 process, because we've always done it that way, really going to help you out into the future? So I would argue that's a lesson learned. It's important that when we think about lease changing, we also think about adjusting our processes. We also, like I said, want to keep track of new contracts and leases and make sure that the right people are involved with deciding if we're signing a lease, what the financial implications are if we sign that lease, what it looks like on our balance sheet, and then also making sure that we're getting lease changes over to the accounting team. And I'll talk more about that in a minute. Before I move on, though, I want to just take a second to talk about trend analysis. Now that we have all of our leases kind of in one spot, either we're recording them in software or, God forbid, you're using Excel, now we can take a look at our lease portfolio and say, okay, I've got this type of lease, maybe it's vehicles, and there's an outlier here. This one particular vehicle, we're paying more money, we have a higher discount rate, maybe we have a longer lease term. When we have all of our leases recorded in one spot, we can further look at those trends and see maybe we've got some outliers and what can we do about them. Maybe it's time to renegotiate those leases and get better terms, or talk about purchase options. So as we talk about year 2, some other things that keep kind of coming up as hot topics in our support team. First of all, how do we handle late payments or prepayments? As a normal course of doing business, we might make a payment early, or we might pay late. That happens. Like I said, I worked in leasing. I've been working in leasing for a very long time. so many years I can't do the math anymore, but in my early part of my career, we oftentimes made payments early, or our tenants would make payments early to us, so the mail got there on time. So how do we handle that? It's important to think about, is it a big change? Is it a material effect to our financials? Maybe not. If I just make a payment a couple days early so the mail gets there on time, that's probably not a triggering event for remeasurement or reassessment. But if I pay a whole year or two in advance, maybe that is a trigger for reassessment. So understanding how that works is important as we work through year two, kind of what's next. We also get a lot of questions about contingent incentives. So as we think about contingent incentives, we think about, we thought we were going to get cash from our lessor for whatever reason, and now we didn't. Or we thought we were going to get $10,000, but we got 15. How do we account for that moving forward? It's important to kind of be thinking about that and know how to handle that. I am going to talk about contingent incentives a little while later. So we'll pause that topic for a second. Oh, I just skipped slides ahead. Let me get there. Wow, that was a rookie move. All right. Next up, variable expenses for existing leases. Now, oftentimes things change. We have scenarios where we might have a variable type expense like a CPI increase. That little increase, we've maybe accounted for it from the beginning of our lease, and now we're adjusting it moving forward. You might also have chosen to keep your lease and non-lease components separate. So those variable type expenses are those non-lease components, and we want to make sure that we're recording those correctly. Payments that increase during our lease term. Now, we should have known that they were going to increase. Lots of times our leases are written, 3% increase over the life of the term. Those 3% increases should have been included in our lease payments. But what if I missed it? What if I didn't do that? How should I handle that moving forward? We're going to talk more about that in a few minutes. And then we're also going to talk about things like remeasurement and modifications and what we do to make those changes. While we're thinking about our current lease portfolio and current processes, we also want to think about our policy elections. These are decisions that we would have made when we implemented 842, but these decisions move forward with us. It's kind of like we made a policy decision and we're going to continue using that policy decision. And the reason I want to spend just a few minutes talking about this now is because I'm going to talk about my thought process for new leases. And I think it's really important to kind of understand our policy elections, and I'm going to refer back to this a lot in a few minutes. So I might need to review my policy elections because I have new staff. I know there's a lot of turnover in the accounting world, and you might have people that had never worked with lease accounting before. So they're going to need to understand your lease accounting decisions and why you made them. The first decision I'm going to talk about is our short-term leases. I am not kidding you when I say our support team answers questions about short-term leases almost every week, sometimes every day. Let's talk about what is a short-term lease, and then I'll talk more about this policy election. So a short-term lease is one that has a term of 12 months or less that does not include a purchase option that we as a lessee are reasonably certain to recognize or to opt into. The short-term leases policy is not for, I have a 3-year lease, but right now I have 6 months left. A 3-year lease is a 3-year lease. It is not a short-term lease. So because I have only 6 months left does not make it a short-term lease, and people get often confused about that. So from a short-term lease policy perspective, we have the opportunity, or we had the opportunity at implementation, to make a decision about how we're going to apply this policy to our lease portfolio. So again, leases of 12 months or less with no options we're going to take. We have the option to say, I am going to apply lease standard to those leases or not. And I also have the opportunity to say I'm going to apply the lease standard for short-term leases to certain classes of assets. So maybe I have vehicles that it makes sense to apply the lease accounting standard to those 6-month leases for vehicles, but it doesn't make sense to do so for buildings where I might have short-term leases. So we have made that policy election as of implementation. It doesn't change throughout our lease accounting journey. Next up is components. So as a policy election, we would have elected to combine or not combine lease and non-lease components into a single component. Those are going to be items or activities that transfer a good or service to the lessee. This could be common area maintenance, parking expense, maintenance on an ROU asset. So we've determined that we're going to combine those components, and then again, this decision can be made based on classes of assets. I will note that when we're thinking about our lease and non-lease components, it's also important to think about and remember that when we are not combining those components, we should be keeping track of our standalone pricing. Basically, that means if I was to go outside of this lease and go find parking in a similar area for a similar term, what is my standalone pricing? What would the price be? So again, policy election for non-lease components is based on classes of assets, so I can make a different decision. Next up is discount rate. Discount rate is a hot topic all of a sudden. Our team is answering questions about discount rate, multiple requests a day. So let's talk about the policy itself. So non-public organizations have the option of using, or not really the option, FASB says non-public organizations should use the rate implicit in the lease. Now, I've been working in this leasing world for a very long time, and it's very uncommon to have an implicit rate. However, sometimes you can determine what that implicit rate is. Let's say, for example, we can't determine our implicit rate. Well, what do I do then? First of all, I'm going to decide based on classes of assets if I am going to use the risk-free rate or my incremental borrowing rate. Now, it is important to note that you're not going to say, well, my rate's 4% and I'm going to use 4% for every single lease in my portfolio, because it's very likely that you have different types of leases, different classes of assets, different lease terms. So all of those leases are going to have different discount rates. But I can say, you know what, for this class of assets, I'm going to use the incremental borrowing rate, and for that class of assets, I'm going to use my risk-free rate. Just remember that those rates are generally not going to be the same for each of your leases. Next, 2 bullets on this slide are really just reminders, not really educational, but classification criteria. We had a choice at implementation to use the bright line for economic life and for fair value. It is really kind of unusual to see people not using the bright line, which was offered to us as part of 840 and moved forward with us in 842. So we don't talk about it a whole lot, but the classification criteria that we had decided on is going to go forward with us as well. And then finally, our presentation. This again is more of a transition topic, but really it doesn't change moving forward. So at inception or at implementation of 842, we had the option to say, I'm going to record this on my balance sheet or only on my footnotes. Most organizations have added these assets and liabilities to their balance sheets, but just remember that you're not going to change that from year to year. That policy election that you had made is moving forward with you. All right, so as we think about keeping up with our lease compliance, there's a couple of things I want to just talk about. The first is staff education. Like I had mentioned earlier, you might have new staff to your organization that's going to need to learn about lease accounting. So where do you go? Fortunately, we've got tons of content available for you. We've got webinars and things of that nature, but it might be a scenario where you just have new staff coming out of college, or just they worked at organizations before where they didn't have leases, so they didn't need to know it. Keeping in mind how you're going to handle those situations is going to be really important. It also might be important to just re-educate yourself on lease accounting. We're hearing from a lot of our clients that they just need a refresher. I just need lease accounting 101 again. Even though I did that a year ago, I still just am a little rusty on what these concepts are. So we are working on content for those as well. Another part of keeping up with compliance would be an internal controls review. So have you documented who your signers are going to be, or who they are? Have you thought through who is going to determine if it makes sense to sign a new lease agreement? Does adding a large lease liability to the balance sheet the right financial decision for the organization? And is that conversation going to occur before the lease is signed? I think it's also important to mention that the legalities of a contract are different than accounting for a contract. We often hear some of the terms used interchangeably, which might not be correct, but it's important to think about legalities versus accounting and how they kind of play together. Again, like I mentioned, new agreements. When I have a new agreement, what am I gonna, am I gonna make sure that accounting knows about it or the financial team knows about it so they can get it recorded correctly? Also, don't forget about embedded leases. If you've ever seen me speak about embedded leases before, you've heard me say embedded leases are not a new concept, but accounting for them under 842 is a little bit different than what we were doing under 840. So are we going to make, who's going to be responsible to make sure that we're reviewing contracts to determine if there are embedded leases? And if you're going, holy cow, what's an embedded lease? An embedded lease is something, an asset that meets the definition of a lease within a service type contract. If you're, need some further information about embedded leases, we have a great tool on our website that helps you figure out if I have an embedded lease. Not all contracts contain leases. Some do contain leases, and some are kind of hiding, which is what we're talking about here. Another concept that I would talk about when we're thinking about keeping up with our lease compliance is subleases. And I know that many people have said to me over the years, my leases don't change, until they call me and say, okay, now I have a sublease and I don't know what to do with it. So when we think about our lease portfolio, we might have a sublease. And what that means is, as a lessee, I determined I no longer need or use the asset, and I'm going to lease it to somebody else to cover the cost. The original lease that I had is then called a head lease, and our sublease is still accounted for from a lessor and lessee perspective based on who the parties are. So it might be important to think about our subleases, because getting into a sublease could also change our lease term, which we're going to talk about in a few minutes. So when we're subleasing, us as a lessee, that really doesn't change. We're still recording our RU asset and lease liability, but it is important to think about how we are going to account for the lessor side of that, becoming a lessor in a sublease scenario, and how my lessee lease changes if my lease term changes. All right, that brings us to our first poll.
Okay, again, the poll question is open right now for your votes. And again, we need you to answer these poll questions to earn your CPE. How did your ASC 842 implementation go? Great, a slog, we're still going, or we skipped it. We got a lot of folks in already. Want to make sure though that we get most of the audience. Keep it open a little bit longer. Answers are coming in here just in just a moment. I will close this and share the results.
Fantastic.
Okay, it looks like I have everyone in. So let me go ahead and share those results. 42% said great. 25% said, pardon?
I love it.
Okay. 25% said a slog, and 31% said we're still going. And a very small group of 1% said we skipped it.
Awesome. Thank you so much for that information. If you are still struggling or need a little help, or just want to vent about lease accounting, I'm your gal. Let me know. All right. So moving on, let's talk about how we might account for a new lease. So like I said before, this is kind of my thought process of how, if I was still in the business of accounting for leases, which fortunately I'm not anymore, this is kind of how I would handle it, or how I would sort of handle it. So first, does the contract fit the definition of a lease? Do I have the right to control the use of an identified asset for a period of time in exchange for consideration? So that's the definition. Once you've determined, yes, the contract meets a definition of a lease, then we're going to start abstracting that data. And I often find that when I say the words abstracting, people might not know what I mean. And what I mean is pulling out the key data. We have certain information that we need out of our lease to determine our lease accounting. So we're going to pull out that key data of that lease. We're going to figure out if the lease has multiple components. Like I talked about earlier, we have lease and non-lease components. Does this, now that we know we have a lease, does it have components, and do we need to account for them separately based on what our policy election was? Next, we're going to determine the commencement date of the lease. The commencement date is the date that the lessor makes the asset available to the lessee. Commencement might not be the same as start date as written into the contract. So that's kind of just one of those things that's important to keep in mind. Next, we're going to figure out our term. What cancelable, non-cancelable periods do we have? Where the lessee has the right to use that underlying asset. We're also going to take a look at the lease and figure out any options. Do we have an option to renew, an option, options to terminate early, and what do we think we're going to do with those? Next, we're going to figure out our discount rate. So like I mentioned earlier, when we have a lease, we're going to use the rate implicit in that lease if available. Like I said, we don't always know that our discount rates are available. So if it's not available, we're going to take a look at that policy election and say, okay, this lease fits this classes of assets, and this is the decision that we made about our discount rates. So you may be using your incremental borrowing rate or the risk-free rate. Let's take a second and talk about that incremental borrowing rate and risk-free rate. The rate that you'll use for your incremental borrowing rate is if you went to the lender and you said, I'm going to buy this asset. It's going to take me 5 years to pay off the loan, and it's $100,000. What's my rate going to be? That's the incremental borrowing rate. From a risk-free rate perspective, we're also going to take into consideration the term of the lease in order to determine what that rate will be. And like I said, they're generally not the same rate for each one of your leases. All right, next we're going to determine which payments are included in the term, fixed payments, variable payments that depend on an index or rate. There's all sorts of lists of payments, which I'm not going to get into today, but we're going to keep an eye on what those fixed payments are and include those in the calculation of our lease liability. And then don't forget that if you're reasonably certain to renew the contract, we're going to think about what those payments might be into the future and include that as well. When we think about variable components, we're also going to think about those payments and how those might change throughout the life of the lease. And then finally, we're going to determine our lease classification. Oftentimes, I have people come into our support team that are like, okay, I have an operating lease, but can you help me determine if it's actually a lease? Or I have an operating lease, but it's actually an embedded lease, and I really don't know if I have a lease. So just remember that when we're thinking about new leases, we're going to determine our classification kind of at the end. It's kind of the last step of thinking about a new lease. Next, let's talk through how we might calculate our lease liability and ROU asset. So we know that our lease liability is the present value of future lease payments. We're going to use the discount rate that we've determined for this particular lease. We're going to present value each of those future calculations and add that all up to give us our lease liability. Then, to determine our ROU asset, we're going to take that lease liability, add in any initial direct costs, any prepaid lease payments, subtract out any lease incentives, and that gives you your ROU asset. I want to take a second here because we're in year 2. I want to talk about those prepaid lease payments. So if I paid the lessor as of my commencement date, or maybe in order to get going on this lease, I made a payment last month, but now today is my commencement date. That prepaid lease payment is not part of our lease liability, and it is part of our ROU asset. Oftentimes that's a question we get, why don't these match? And it's okay that they don't, they're not supposed to. All right, so now let's talk about some numbers, like an actual example of a new lease. I've already abstracted this lease. It's totally made up, not something I actually pulled from the software, just kind of to give us some round numbers. So this is an office space with parking. I think about this, I'm in Milwaukee, so I oftentimes think about office space with parking. That's the cream of the crop if you're in the downtown area. So we've got a 5-year lease with 1 5-year renewal option. The lease was signed on 8/1/22, but not made available to the lessee until 10/1/22. So our commencement is 10/1. That's when we start recording our ROU asset and lease liability. There was no rate implicit in the lease. The monthly payments for this lease are $1,700 per month with a 3% annual increase occurring at the beginning of each year. The lease also includes a parking fee of $150 a month. Finally, we know that we've classified this lease as an operating lease. So a couple of things to mention as it's related to policy elections, like we spoke about earlier. This particular organization has chosen to use their incremental borrowing rate for this class of assets when the implicit rate was not available. So their incremental borrowing rate is 5%. This, like I said, arbitrary, totally made it up. This organization has also chosen not to combine lease and non-lease components. Therefore, that parking fee is reported separately. So let's take a second also to talk about the term and the payments associated with it. We know we've got a 5-year term. We're reasonably certain to renew or exercise that purchase option, gives us a 10-year lease. We need to think about 10 years worth of lease payments as we're determining our lease liability as well. Also, you want to check your lease. Sometimes your lease will tell you what your payments are going to be in that renewal period. When we used to write leases, we would include that information. Obviously, it might change. You know, leases are renegotiated all the time, but we generally kind of had an idea of what future cash flow was from a lessor perspective. So we usually included what we thought the renewal rent might be. Not all leases are written that way. Let's talk for a second about that parking expense. We mentioned earlier that parking expense is at standalone pricing when we are not combining components. Standalone pricing in this scenario means I'm going to go find parking somewhere else to figure out what it might cost me. So that's what we mean by standalone pricing. All right, so now we're going to figure out what our calculation is. We're going to take the present value of each one of those payments, and that's going to give you your lease liability. And I apologize, the colors are a little wonky on here. At the top of the right side, it says initial recognition and then debits and credits. So we determined our lease liability to be $180,585. That's the present value of the $1,700 payments with their 3% increasing over the term of the lease. Next, you'll see that I'm recording $150 for the parking, right? That's not part of our ROU asset and lease liability. And then finally, you'll see at the last 3 lines are going to be our operating lease expense, our ROU asset reduction, and our lease liability. You'll notice that the operating lease expense does not equal the cash payments, and that is especially common when we have escalating rent payments in our lease. This is totally okay, and it's because these numbers are calculated differently than what we may have been used to under 840. Excuse me. So what we've done in this scenario for operating lease expense is we've taken the total payments we're going to make over the life of the lease and divided it by the lease term. That gives us that expense of $1949. And then of course, a straight line reduction of the ROU assets, and then a recording of our interest on remaining lease liability, and adjustment with that payment gives us a change in lease liability. And that brings us to our second poll.
Okay, poll is open. The question is, what did you use to track leases and account for the new requirements of ASC 842? Excel, a software solution, both, or not sure? And again, we want to keep this open to make sure that you get your CPE. This group is really fast, Jess. We're almost there. Which is fantastic.
That means they're paying attention to this exhilarating content.
Yes. We are getting some questions in. Please continue to send them. We will open it up for questions at the end. So I'm going to go ahead and close this. Looks like everyone's in, and share those results. 22% said Excel, 49% said a software solution, 23% said both, and 6% are not sure.
Awesome. Thanks for that. All right. Now let's talk about lease changes, because leases change. We're gonna think about questions on, you know, kind of how we might think about changing of our leases. But before we dig in, let's talk about a couple of things. If you're a LeaseCrunch user, I know that Josh knows this, but throughout our software, we've got blue question marks. And when you click on those, it'll take you exactly to the topic that you clicked on. Later on in this presentation, I'm going to have a screenshot or kind of a rebuild of one of my favorite charts or tables, if you will, that talks about what changes when we have certain types of lease changes. Like, when do we need to update our discount rate? When do we need to update classification? So in a few slides, we'll take a look at that. But before we do, let's talk about all the different ways that leases change. First of all, we might have a change in lease term or purchase option. So here we're talking about, we've been in a lease for a period of time and now something changes from a lessee's perspective. This could be that we've decided to renew a lease when we hadn't planned to exercise that option before. We're going to reassess an event in a contract when a lessee decides to exercise or not exercise an option. We're also going to reassess when a lessee elects to exercise an option it was not previously certain to exercise. So that's kind of a lot. Think about it like this. When my lease term changes, or when something occurs where I think I'm going to change my purchase option, decisions, that's when I'm going to reassess my term. So a triggering event is a significant event or change in circumstances that is both within the lessee's control and directly affects the assessment of whether the lessee is reasonably certain to exercise an option. So let me talk about some examples of triggering events. Constructing significant leasehold improvements that are expected to have a significant economic value for the lessee when that option becomes exercisable. So what do I mean? Say that we're in year 9 of a 15-year lease and we construct significant improvements. They have a big, significant value to the lessee, and they will last for 15 years. That might be a triggering event to reassess my lease term, because where I wasn't reasonably certain to exercise an option in the past, now I am. Same goes for significant modifications or customizing to an asset. And subleasing for a period beyond the exercise date of an option. We talked about that a little bit earlier. So what I mean by this is when we sublease an asset for a period longer than the term. Say I have 2 years left on my term, but I sublease it for 5. That's probably a triggering event. We need to reassess our lease term. Also, very important to note, we've had many changes in the market in the last couple of years. Market factors alone do not trigger reassessment because they're not generally in the lessee's control. So when we're thinking about assessments, we're thinking about things within the lessee's control. So they're usually triggered by something. Important to also note that we're not going to reassess our lease term every month, or even sometimes every year. We're going to reassess our term when something triggers us to do so. When we do have a triggering event, we're going to update some things. We're going to take a look at our lease payments. We're going to reallocate consideration. We're also going to update our discount rate and our classification. So important to kind of just think about this when some triggering event forces us or nudges us to update our lease term and purchase option. These are the things we're going to update. Kind of thinking about it like it's a new lease. It's also important to just note that if we remeasure or we reassess the term and end up remeasuring our lease, and we reduce our ROU asset to 0, we might be recording a gain or loss for this particular lease, especially if you have an early termination. That's very common. All right, the next change is a change in amount probable for your residual value guarantee or a resolved contingency. I mentioned contingencies earlier today. So a change in the amount probable of being owed by a lessee under a residual value guarantee is an event that can cause us to remeasure our liability and our RU asset. So in this case, we remeasure when relevant factors or circumstances change. So that could be any point during the lease term. When variable payments become fixed during the lease term, that might be when a lease maybe is written in such a way that we have a rent based on a % of sales or usage. Let's talk about an example. Maybe we have a retail lease, and in year 1, rent is flat. And in year 2, our rent is a % of the year 1 sales. That's really common in the retail leasing world. At commencement, we measured this, and it was determined that that % of sales was variable. So it's not part of our lease liability or RU asset. But now that year 1 has passed, that contingency is being resolved. We know what our sales are, so we can figure out what that % of year 1 sales is. We're going to remeasure the lease at that point. When we do so, we're going to adjust our lease payments, allocate consideration, but we're not going to change our discount rate or our classification. So again, something changes, we've got a triggering event, and in this scenario, we're not going to change our discount rate or classification. Contingent lease incentives, I already kind of talked about this, but if we were reasonably certain that the incentive would not become payable, but then, and we didn't include it in the calculation of our lease liability, but then it does, we should remeasure our lease at that point. This is probably not super common, but sometimes things change. It's also important to note that there might be some differing in practice on this. So just keep in mind on that. You might need to be speaking with the Richey May team on that particular topic. And now let's talk about modifications. A modification is a change to the terms or conditions of a contract that results in a change or scope or consideration. These are changes that add or terminate the right to use an asset or extends or shortens the contractual lease term. Leases are modified. When they're modified, there are generally some circumstances. There are some circumstances where you should account for that lease as a separate agreement. So we're going to go back to that new leases slide and adjust that way. So those criteria, when the lease, or when the modification rather, grants the lessee an additional right to use that wasn't in the original contract, and lease payments are commensurate with standalone pricing, then we're accounting for this modification as a brand new lease, brand new ROU asset and lease liability on the books. If it doesn't meet that criteria, it's not a separate contract, and we're going to remeasure what we knew about the original lease. Modifications do also not need to be in writing. They just need to imply an enforceable right. So if it is a separate contract, like I said, we're going to measure it as if it was a new lease, like we did a few slides ago. And if it's not a separate contract, we're going to remeasure the existing lease calculations, reclassify that lease, use an updated discount rate. Concessions. So oftentimes you might have a concession that's offered to a lessee after commencement. We're going to account for them a couple different ways depending on the enforceable right in the contract. So usually when we have a concession, there's no enforceable right to the concession under the original contract. Lots of times in the real estate world, the concession might be granted for you had a leaking pipe and you couldn't work in your office for a few days or weeks. We're going to give you some money back. Some examples might be that the lessor granted forgiveness of past due rent, or like I said, it was a maintenance issue, rent is abated. Those are going to be scenarios where we're going to modify the lease and we're going to account for that concession or abatement. We're freezing those original calculations and modifying that lease moving forward. And in this case, we're going to adjust and reevaluate our discount rate and our classification. Impairments are a topic that I step away from. Impairment guidance, leasing or leased assets should be accounted for under the impairment guidance in topic 360. You're going to reduce and adjust your ROU asset using the same concepts that you would for other owned assets. And it is my favorite when I can say, you know, that's not really something that I cover. And then finally, I terminate my lease prior to the expiration date. What do I do with it? For example, I had a 10-year lease. We were going to stay in the lease the whole 10 years. We were not going to terminate early, and in year 8, something changes and we need to do so. In that case, we're going to remove the ROU asset and lease liability from the balance sheet and record a gain or loss. So in that scenario, we're really not doing anything with our discount rate or our classification, but it is important to note that we're going to write that information off. And as promised, this is the chart that I was referring to earlier. It kind of is a nice cheat sheet. I'm sure you can print this up. When you'll get the slides, you'll be able to print this. And it kind of gives you a guide as to like these adjustments to our leases and when do I update my classification and discount rate. And if you do have some exchange rates, we've got that information for you here as well. And that moves us to our third poll. And then we have some kind of other stuff that we're going to lean into.
Okay, our third poll question is open. Do you have new leases to account for this year? And it's either yes, no, or not yet. Again, we have a lot of votes coming in early. This class is amazing how fast they're coming in. So I'm just going to hold off for a few more minutes few more seconds before I close it and open it up. But it looks like we've got just about everyone in. Any other folks want to? Okay, we got one more. Okay, I'm going to go ahead and close this now and share these results. 60% said yes, 18% no, and not yet is 22%.
All right, fantastic. So let's talk about dates. If you've ever read a lease, which I'm sure many of you have, like I said, I was in the real estate world, so leases were 40 pages long on the regular. There's all sorts of dates. So when we think about how our leases change or could change, it's important to start thinking about renewal options and termination options. When should you start deciding about those options? Is there incentive for you to renew this lease by a certain date? Are we going to handle our renewal options in a certain way based on classes of assets? It's important to be thinking about all of these, especially when we think about those lease changes. When does a discount rate change? And who's going to be responsible for those particular changes? When I speak to clients and users of our software, I think it's often a little kind of questionable about who should be responsible for what am I going to do with this lease? And I don't think the who matters so much, as long as you have somebody that's taking a look at these renewal options or taking a look at the dates in the leases to figure out, when do I have to give notice? If I do decide to move out, is it a year in advance or 6 months in advance? And who's going to be ringing the bell about, you know what, we're almost to 6 months. What are we going to do with this lease? So thinking about dates and how it affects your organization is going to be really important. It's also really important when we think about our termination options. So sometimes you're going to know in advance that you're going to terminate early, and you'll account for that at commencement. However, sometimes things change and we don't know that we were going to terminate early. So when I do, or I need to terminate early, what kind of information is in my lease for that particular option? And again, who is the responsible party within your organization that's saying, you know what, if we terminate this lease early, here are the things we need to consider. So making sure that you've just got somebody keeping an eye on those dates is going to be really important. So next up, just a few of my best practices on reconciliation. So we've heard from many of the firms and their clients that we work with about this matter. And a lot of our, we have all sorts of clients that we work with, many industries, industries that I never even gave thought to before in my life, and all sorts of leases, and all sorts of different types of reconciliation and different types of kind of management. So I've thought about this at length, and I think back to my old life when I was doing month-end reporting and how I might handle this. I would say it's really important to make sure that you are reconciling regularly. So making sure that your assets and liabilities and your expenses are tying out for the period frequently. If you don't have a lot of lease changes, maybe you're doing that just, you know, every 6 months or quarterly. But if you have a lot of lease activity, it's probably helpful to do that monthly. If you're a LeaseCrunch user, you know that we recommend using a clearing account and making sure that we can talk about the balance. If there is a balance in that clearing account, it should clear itself out. But you might have timing of payments that are adjustments there. Keep that in mind. I would also say you should have a plan for what you're going to do when you run into issues. We are all human. We have all been doing accounting for quite a while, and it's important to think about, what am I going to do when something goes wrong? In a previous life, I managed a 10-person accounting team, and we did monthly financials for 150 properties. Something always went wrong. Every single month there was something wrong. So how do we handle that? Where do we go back? How far do we go back to re-reconcile? You know, what processes do we have in place to maybe review the GL to make sure things are posted in the right spot? Because if we're, you know, manually typing in journal entries, we might have recorded it to the wrong account, or maybe our invoice was posted to the wrong place, all sorts of scenarios. But I would say having an idea of what you're going to do when you have issues is going to be a really good best practice as we roll into year 2. A quick comment about leases under common control. Earlier this year, the FASB announced a change to the ASC 842 specifically for leases for within parties under common control. They clarified that related party lease documents do not need legal review to determine if there is a lease. There's lots of conversation about legally enforceable as it's related to related party leases. Basically, they stated that if you have leases under common control that are not documented, go ahead and do so. It's also, I want to just clarify rumblings. This topic does not say if you have a related party lease, you do not need to record an asset and liability. That's absolutely incorrect. You have a related party lease. If it isn't documented, go ahead and document it. And then the practical expedient is to use the written terms and conditions to determine if the lease exists and then what the classification and accounting for that lease is. Within that same ASU, we talk about leasehold improvements for those related party leases. We're going to amortize those leasehold improvements over the useful life of the common control group, regardless of the lease term. All entities, if before the end of the useful life of that common control group, the lessee relinquishes control of the asset, those improvements are deemed transferred to the lessor and adjustment is then made to equity. A couple more slides. I know we're getting close on time. Just a few things that kind of count in like the other bucket. First and foremost, scrutiny from regulators. I know that we've had lots of conversation from clients about, well, I'm just going to take a gap departure. And I want to just tell a quick story about that. We had a client that took I'm taking a gap departure, and now their business got sold. And now they need to start recording their leases. So I would be just be aware if you did, take a gap departure, keep an eye on, is it still okay with your bank, especially in this current environment where banks have failed this year. If you were with some of those, Silicon Valley Bank, Signature Bank, First Republic Bank, things are getting tightened up. Does it still make sense for you to have this gap departure, and does your bank still agree? Hot topic, sale and leaseback transactions or arrangements. There's lots of guidance on this particular topic, and I am not an expert. It is important, though, to think about if you have a sale leaseback transaction, we're going to apply topic 606, so revenue, to determine if there's a contract. The seller becomes the lessee and the buyer becomes the lessor in a sale leaseback transaction. And there's some pretty specific information or pretty specific details about these arrangements to make sure that you're recording this information correctly. So we're not going to go into the details of this, but just know that if you do have a sale leaseback arrangement, there is some specific guidance about it. Another kind of hot topic that keeps coming up is, okay, I've got a finance lease that I purchased at the end of the lease term, and now I need to record my fixed asset, but how do I do that? So if you're using LeaseCrunch, which we hope that you are, you'll have a longer ROU asset life than you had your lease term, and our system will automatically give you that fixed asset amount. It is also important that if your lease is changing during the term that you purchased that, maybe you exercised a purchase option early, then you're going to transition that into a fixed asset and you're no longer going to have a lease. So I know that some of you had said you're using Excel, and I keep hearing, and I think Abby and Josh keep hearing, that Excel is getting hard to handle, especially when you have 10 leases or even 5 leases. I've got these changes to make, I've got revisions, I've got, changes in lease terms and payments, and it's getting to be just tough. So what do I do if I'm thinking about transitioning to software? First of all, budget. Make sure that you're budgeting for software and start shopping. Keep in mind that some software vendors require a long road to get to implementation. LeaseCrunch is not one of them. We can get you up and running in just maybe a day, a couple hours. But keep that in mind. Also identify your key administrative information, GL accounts, thinking about when you will transition into software, what that looks like for your organization. If you are thinking about that, our team is happy to help kind of talk through those different things to make sure that you've got kind of all your T's crossed and your I's dotted. We also want to make sure that you're allocating time and resources. If you do plan to transition into software, do not underestimate the amount of time it might take. Obviously, if you have a small portfolio of leases, it shouldn't take long. But if you have a larger portfolio, it might take some time. So make sure that you're thinking about that, and also a plan for validating that data once you get it into a software. And then, of course, adjusting entries. It is highly likely that when you transition to software, you're going to have some present value methodology differences, and how will you record those? There might be some adjusting entries that you'll need to make. So thinking about when you'll make those entries, how you'll make those entries, what it'll look like for your organization is really important kind of before you get started.
Okay, our last poll question, I had to shorten it to make it work in the software, so let me read it. Under the new guidance for private entities, you need to amortize leasehold improvements over the useful life to the common control group, regardless of the lease term. True or false? Again, answers coming in really quickly, and I don't even have any Jeopardy music, but I appreciate how everyone is answering really quickly. This is our last poll question to get CPE. If you can go ahead and answer it. Okay, just a couple more seconds to get all those folks that have voted up to this point in. I can see there's just a few more. If you can get your answer in, that would be great. Okay, I'm going to go ahead and close this poll and share the results. 69% true, 31% false. So Jess, is there a right answer?
So technically, the answer would be true. If you're me, true and false questions are the hardest. So no harm, no foul. We're not grading you on correct or not, just for your CPE credits. Good stuff. All right, that's enough of me, I think.
Yes, and now I'd like for Josh and Abby just to come back with us. And Josh, if you could be our host, we have a few minutes left to get a couple questions in. We have received a bunch of questions. If we don't get to you right now, we will make sure we reach out to you individually after this webinar.
Yeah, thank you, Felicia, and thank you, Jess, for giving us a good, thorough rundown. I think we have about 2-3 minutes left. A handful of questions, probably close to 10, but I think we can hit a couple of low-hanging fruit ones, and then, as Felicia mentioned, we'll certainly touch base with you all individually, and probably actually put together maybe even like an FAQ and send it to this entire group, just so if they have that question in the future, they'll have have the proper guidance for it. So. The first question that came in was, we have a 5-year lease that has an early out clause that gives you 3 months, that if you give 3-month notice, you can terminate the lease without further penalty. It's a good lease. Would you reflect the full 5-year lease within the right of use asset, or treat it as a current lease with less than 12 months left? So I think, again, as we look at the standard, and Jess, feel free to jump in here, but I think you need to look at the likelihood of exercising, any termination clause at commencement, and just determining whether or not, that's something that you may take up on the lease. Otherwise, yeah, it should be recognized as a 5-year lease agreement. And then if and when you determine that that you are going to back out of that lease and take that early out clause, you would essentially use that determination date. So, that 90-day period that you're speaking of, at the 3-month period, to essentially demeasure, that lease and bring it back off the balance sheet. Anything to add there, Jess? I know there's no early out, so there would be no, penalty to that. But if there was an early out, that would just be a loss on that lease that you would book to operating expenses.
Yep, absolutely. I just want to clarify the question about the current lease. You had a 5-year lease and you're going to terminate it 3 months early. That doesn't make it a short-term lease.
Correct.
So the short-term lease policy that we talked about earlier is really about, I have a short-term lease, a lease that's less than 12 months as a whole. So this was never a 12-month lease. It was always 5 years. So we're not counting that, and we're not going to talk about it as a short-term lease in that regard. And if you're confused about that concept, I understand, and we're happy to help.
Absolutely. Next question, I think, will probably be at about time, similar to kind of the length of a lease agreement. If there's a lease term that's 5 years with that renewal option for additional 5, should I be recognizing 5 years at commencement, or should I be recognizing the full 10 years? So every year of that renewal option. Again, you really need to evaluate this upfront as you're making a determination on is it reasonably certain that you're going to be exercising that option, yes or no, and what kind of economic factors are in play there. But really, as you're evaluating that, it needs to be at the inception and commencement of that lease. If you are, further down the road, say it's year 3, say it's year 4, and you're saying, hey, we're probably not going to be doing this, I think this goes back to what Jess talked about in terms of, is this a modification situation now? And are we going to be, at the end of that 5-year period, are we now going to be backing out of this? So again, trying to make that determination sometime between the 1st year and the 5th year, whether or not you're going to extend, or whether or not you're going to accept that renewal option. Anything to add there, Jess?
No, I think that's exactly right. If you are reasonably certain, which remember is a high bar, that you are going to opt in to that second term, you have a 10-year lease. So when you get to year 4, maybe that changes, right? If something about it that changes and you no longer opt into it, then you account for that and de-recognize that ROU asset lease liability. But at the beginning, If you think you're going to, reasonably certain, high bar, reasonably certain opt-in, then you'll record it for 10 years and you'll include, whatever payments or you're expected to make through the term.
I think that puts us right at the top of the hour. So I just want to thank everyone for joining us today. I want to thank Jess and Abby from LeaseCrunch. Just to circle back on the roles that they play. Jess is the brains behind the operation. A lot of times when we have that complex guidance and need some answers for client questions, we're going to her. Abby is really that person that we utilize, just to make the introduction to LeaseCrunch. If there's any demos that need to be set up, I mean, usually if there's a demo that needs to be done, please reach out to Richey May. We can get you guys set up on that. But if there's anything further beyond that, she's really more or less our liaison to LeaseCrunch, and keeps me in tune in terms of who's reaching out to her with questions and opportunities. So anything else from you ladies before we let everyone go?
You could just go to the next slide really quickly. If we didn't get to your question, we will follow up with you after this. If you have any additional questions, please send them directly to info@richeymay.com. And Jess, did you want to have just one last moment there with your slide?
No, thank you so much. If you have any questions, like Josh said, happy to help. I know that the guidance is complex, and I completely understand. So happy to help if anybody has any questions or follow up. Thanks so much for having me.
Thanks so much for joining us, Jess and Abby. Appreciate it, everyone, and have a great day. Thank you for joining us.